been Reppond. Welcome to my YouTube broadcast. Today is, believe it or not, March 1st, 2023. A couple of months already behind us. I'm going to go over the stock market, the bond market, precious metals. We're going to cover all that. I'm going to start with my dashboard showing the 6 major indexes that I track, equity indexes, and the one government bond index, TLT. What's interesting, last week was a negative week in the market, generally speaking. You can see that in the yellow box in the center that everything is negative. That's a result from last week. Over in the green box, you can see that year to date, they are all positive, except at the bottom, the Dow Industrials turned slightly negative. I drew a white line through the middle of it, show right underneath the S&P 500 SPY, to show where it is relative to those that are more aggressive than it on both the weekly and the annual, and then those that are less so underneath that. Even after last week, the growth stocks, the NASDAQ 100, still had a gain for the year of 9.6%, and for last week was the biggest loser, not the biggest, almost the biggest loser, at 3.7. And so those that have been doing well, like the NASDAQ 100, small cap, developed markets, those did very poorly last week, and vice versa. And the number of red dots, those that are below their 20, 50, 100, and 200-day moving averages, the number of red dots more than doubled from a week ago. So again, showing weakness in the market. The S&P 500 has 11 sectors or components to it, and there are stocks in the S&P 500 that are in each of these sectors. Again, I did the same thing. Showing last week, I put that in yellow, and then the year-to-date in green. You can see that the ones that have done very well year-to-date, namely consumer discretionary, retail, and technology, those were among the worst for last week, but they were the best for the time before that, for the whole year-to-date. Again, the number of red dots, number of sectors that are below their 20, 50, 100, and 200-day moving averages more than doubled from a week ago. Now, this is a chart of the S&P 500, so you can see over a 14-month period where it's gone. I drew the black line. Generally speaking, it's going down. It's still going down, and it has not broken that trend line of going down. It started to, but then it collapsed. And then now it's kind of touching the 20-period moving average. So short-term, probably indecisive, and long-term, meaning 14 months, more negative. Growth versus value. This is a relative strength chart. So showing growth as a numerator, value as the denominator of the stocks within the S&P 500, the growth stocks and the value stocks. So when it is going up, that favors growth. When it is going down, that favors value. So you can see for the last 14 months, generally speaking, it has favored value and still continues to favor value when looked over that long period of time. At some point, it will be able to go on back up and probably favor growth. But you can see last summer where it attempted to do that, thinking, okay, we're done now, we can get on with growing. No, not so quick. And then the props were pulled out from under it and it collapsed. So that's where we are now. Small cap versus a large cap, the S&P 500. Small cap is the Russell 2000 index measured by the exchange traded fund IWM. And so when this goes up, this favors small cap, and when it goes down, it favors large cap. So you can see across the bottom, generally speaking, very gradually, it is starting to favor small cap over large cap, but not very much. Long-term government bonds, the ETF, TLT, I show over a 32-month period of time, 2 periods of decline marked by the black arrows. The first period goes back a couple of years, and the more recent period, you can see, goes back over a year now. This is about 14, 15 months, and it's generally been in decline. And you can see the times where it attempted to go back up, and not so quick. It was brought back down. Why? Bonds are a function of interest rates. As interest rates go up, the bond or the bond fund or ETF tends to go down. So with the thought of anticipation of higher interest rates coming, it's starting to push this ETF down, and it is not yet really showing strength. And that's significant because that or other ETFs or funds are part of traditional portfolios, and that causes them to continue to be in trouble. US dollar went up for a long period of time. This is a 20-month chart, weekly chart. It went up, and then the dollar came back down, and now it's starting to go back up again. You're starting to see strength in the dollar. Now, this is important because it's relative to other currencies. Any one currency, the dollar or any other currency, does not sit out there by itself. It is always relative to other currencies. So I would say, and usually we compare ourselves to either the British pound sterling or the euro. But the dollar is compared to all of them because we are the reserve currency. Gold, measured by the ETF GLD, you can see has had 2 periods of decline, a longer period. This is a 12-month chart, a longer period, and then more recently, it's gone down as well, not showing strength. And silver, even more so, longer period down, and then a sharper decline in the past couple of months, 2 or 3 months. When I put those on a relative strength chart, silver being the numerator, SLV, and GLD for gold being the denominator, you can see how that favors gold, because when it goes down, that favors gold. They may both be going down, which they are currently, but gold is going down at a slower rate than silver is. So the sharper this line, the more favorable relative to the other one it is. In this case, it's favoring gold. Bitcoin has come off of its bottom at the beginning of 2023 or late 2022 and has gone back up, but it has struggled recently, and we'll see where that goes, but it's definitely not quite as weak as it was, and but it's not yet showing a strong pattern of uptrending. Volatility index, this measures usually the negative volatility in the market. So when there is negative pressure, like in this case on equities, the S&P 500, which we saw last week, then this causes the volatility index, the VIX, to go up. That shows an increase in volatility. And so, which means weakness, generally weakness in the market. The black line is my artificial line of saying when it's below this, it's not as much in trouble. When it's above it, that's particularly if it's coming up through that black line, that's showing that there is a significant amount of increasing risk coming into the market. And we're not there yet. Asbury Research does metrics, and this is the chart showing their Asbury 6 set of metrics, 6 metrics, and all of them this week and all of them, I believe last week, I think they were all negative. So showing that, weakness in the market. Their cross-asset relative performance chart shows the green boxes, the ones that are more prevalent. Small cap is more favored than large cap. We saw that in the previous charts. Broad market, the S&P 500, is more favored over the Dow Industrials. We saw that in the previous charts, that the Dow is not as strong as the S&P, or for that matter, the NASDAQ. High yield bonds are more favored over high quality bonds, and short-term bonds are favored over longer-term bonds. U.S. versus the world. It has been a long time since we've seen the U.S. We still don't see the U.S. in any one of these categories. So we compare to a few of the zones in the world and in a lot of the countries, both developed and underdeveloped countries. And this time there's three that are the strongest in the weekly, the monthly, and the quarterly views. And so Spain, the United Kingdom, and Mexico are all stronger in all three time periods than the U.S. And the U.S. is around, you see it's stronger, barely stronger, not enough to even get a green box. I've shown this in the last few weeks, the U.S. versus Italy. I'm just picking this as a country that has been relatively strong versus the U.S. And this shows the degree of strength that Italy has. And you could infer from this, even generalize and say it's also true of other European countries, stronger than the U.S. And the U.K. is certainly stronger right now. And this is a surrogate for the European countries. Gold and silver. Now you've seen the charts on gold and silver. So these are the numbers. So as of Friday, last Friday, the gold was $18.15 per ounce, and that is down 1.5% from the previous week, February 17th. Silver is $20.78 per ounce, and that is down 4.2% from the previous week. The Dow journey, enough for you? The market, it's just referring to the Dow, but the market in general for the past 14 months has been on a roller coaster. In 2022, the market went down, generally speaking. If you back away and look at it, which we did, you see there are periods of time where it tries to go up, it becomes oversold for a short period of time and then tries to go up, thinking maybe we'll go up from here. I don't know who's thinking that. Maybe retail investors, maybe traders. And then it collapses. And 2022 was about that, going up and down, up a little bit and then down further. And so it went. And in 2023, I think the market investors were thinking, okay, that's behind us. Now we're going to get on with a growth market. Not so quick. The January and the first part of February, definitely growth market. However, in the last couple of weeks, 10 days, the market has started, you saw from the previous data, the market has started to come back down again, just like last year. It doesn't seem to have gotten out of its system. These short-term spurts, we will see, we will endure them, but the market has got more downside to it if you believe historical patterns. And so I think we've just got to get ready for a rough ride. I think there's more downside, it's my opinion. And there will at some point be a genuine growth economy. We are just not there yet. When we are, we'll talk about it. Meanwhile, this is what we put up with. Thank you for watching. If you have questions or comments, leave them in the comment section below, and I will try to answer them. Thank you.